Are you an investor and looking for stocks to buy? Well, this video will help you learn the most purchased stocks that the elites already have. The unpredictable short-term rise and fall of stock markets are ignored by long-term investors. Instead of getting sucked into the drama, they invest in shares of dependable businesses with consistent performance over years or even decades. The finest long-term investments are equities of expanding companies that offer consistent profits. You need to comprehend the measurements that offer reliable proof of trustworthy long-term success to locate them. Something like consistently exceeding the S&P 500 and avoiding the significant short-term dips and gains that high-flying companies frequently experience. Number 10. Diageo PLC. This UK-based company is about a $100 billion beverage company. Diageo, a consumer defensive business, should be able to withstand a challenging macroeconomic climate because alcohol is often generally recession-resistant. Alcohol customers, like those who use tobacco, have a good amount of brand loyalty, and the corporation enjoys an enviable position in the market thanks to its portfolio of premium brands, which includes Johnnie Walker, Guinness, Tanqueray, Don Julio, Smirnoff, Baileys, Ciroc, and Bullet. Despite net sales increasing by 21.4% in the previous years, the stock decreased by 17.4% last year along with the overall market. This is partly because of its British base and a poor year for the pound sterling. Although that downturn can't stay forever, shares are now trading for less than their 5-year average, ahead of 24.4 at 21.5 times forward earnings. Number 9. Taiwan Semiconductor Manufacturing Co. Limited. The next company on the list is Taiwan Semiconductor Manufacturing, a $500 billion company that dominates high-level foundries manufacturing cutting-edge semiconductors. TSM has a substantial market share for 7nm chips and is smaller in the semiconductor sector. Foundries are businesses that produce chips for other businesses. One of TSM's largest clients is Apple, which has started to move its supply chain away from China. Both the top and bottom lines of the company's fourth quarter results, which saw a 43% increase in revenue and a 78% increase in earnings per share, exceeded expectations. TSM, which trades at barely 14 times earnings and pays a 1.9% dividend, is incidentally yet another stock that Buffett owns. And take note, since January 20, 2023, its shares have soared by 29.8%. Number 8. Grupo Aeroportuario del Sureste SAB de CV, or ASR. This off-the-beaten-path investment is an $8 billion Latin American airport operator, another repeat choice from the list from the previous year. ASR, the only industrial firm on this list, offers geographic diversification, is a mid-cap company that few investors are aware of, and is the only industrial company on our list. With a total return of 17% in a bear market in 2022, the stock was a gem in the rough. Therefore, the fact that passenger traffic started to pick up again this past year was beneficial. In January 2023, passenger traffic increased by 29.8% year over year, driven by increases in Mexico at 33.6% and Puerto Rico at 37.8%. Airport managers make money from a variety of sources, including parking, ground transportation, airport retail, advertising, the leasing of gates, and payment of landing fees by airlines. Cancun, Mexico, San Juan, Puerto Rico, and Medellin, Colombia are home to ASR's biggest airports. The dividend yield on the stock is 2.9%, and as of February 9, 2023, shares are up 15.2%. Number 7. EOG Resources Inc, or EOG. EOG is a U.S. oil and gas producer coming off a stellar 2022 in which shares achieved a total return of 56.3%. It was a return pick from the best stocks to buy list from the previous year. Shares still trade for approximately 10 times earnings and about 9 times forward earnings, which is indicative of a value stock. growth will undoubtedly slow down in 2023 since the hot energy market is unlikely to soar as it did in the year 2022, which was afflicted by inflation and war. But investors shouldn't discount the importance of having an inflation hedge in their portfolios. EOG has considerable credibility with income investors thanks to its 2.6% dividend yield and a remarkably low payout ratio of around 24%. Early in 2023, as inflation worries subsided, EOG shares barely maintained their level of performance, registering a year-to-date loss of 1.2% through last month. Number 6. PayPal Holdings Incorporated, or PYPL. I'm sure that you're familiar with this. PayPal, an established and well-managed financial firm, is trading for less than it did before the pandemic, but has earnings per share in 2022 of $4.13, which is more than any year between 2018 and 2020. Due to a worsening macroeconomic environment and the termination of its profitable partnership with eBay Incorporated, the company's shares took a severe beating in 2022, falling 62%. Despite a 5-year average price-to-earnings ratio of 36.5, shares currently trade for around 20 times the anticipated 2023 earnings. The lowest PE ratio for PayPal between 2015 and 2022 was 20.3. Applying that conservative multiple to the $4.75 average predicted 2023 earnings results in a price of $96.43 per share by the beginning of 2024, suggesting an increase of nearly 23% from the closing on February 9. Its footprint in physical stores may increase as a result of recently announced agreements with Apple Pay to accept PayPal and Venmo-branded cards. Amazon now takes Venmo, providing PayPal access to its enormous online marketplace. Through this month, PYPL stock has increased by 10.1%. Before we move on, let us know what you'd like to see in our videos. Comment down below and don't forget to click the like, subscribe button, and hit the notification bell to keep the videos coming. Moving on. Number 5. Walt Disney Co, or DIS. The management team of a firm is among the most crucial factors to take into account when choosing stocks to buy and hold for the long term. And Disney has that in spades with the recent return of long-standing CEO Bob Iger. Before handing the reins to Bob Chapek in February 2020, Iger, who was regarded as one of the best CEOs this side of the millennium, presided over a string of enormously profitable acquisitions including Pixar, Marvel Entertainment, and Lucasfilm. Disney just released its first earnings report since Iger's return for the fiscal first quarter, in which Disney beat revenue and profitability estimates by a wide margin. While revenue from its theme parks increased 21% in the quarter following a price increase for the streaming service Disney+, subscriber losses were less severe than anticipated. The results of Iger's magic touch are clearly visible in 2023 as Disney shares have increased 27% through last February. Number 4. Amazon.com Incorporated, or AMZN. Leading into the new year following a horrible 2022 in which shares lost 50% of their value, dominant online retailer Amazon was also named one of the 10 best stocks to purchase for 2023. Cost growth, a tight labor market, supply chain issues, and declining consumer confidence were the main offenders. Nonetheless, the market was far too quick to write off Amazon, whose crowning achievement is its sizable, rapidly expanding, and wildly successful cloud services division, Amazon Web Services. Around $85 billion in income is generated annually by AWS. Assuming that Microsoft Corporation, or MSFT, a competitor in the cloud services market, trades for approximately 10 times sales, valuing AWS at the same multiple would put its value at $850 billion. Investors can acquire the remainder of Amazon's enormous operations, which reported 2022 sales of $434 billion for around $150 billion at the company's current $1 trillion valuation. AMZN has so far proven to be a wise investment, with shares up 17% as of February 2023. Number 3. Citigroup Incorporated, or C. The next company is Citigroup, a $100 billion global bank with divisions for retail and investment banking. Citigroup provides investors with benefits. It pays a respectable 4% dividend yield, providing owners with a welcome cushion in a time of increasing rates and high inflation. Importantly, that dividend is long-term sustainable, with Citigroup financing its dividends with less than 30% of earnings. With a present valuation of fewer than 8 times forward profits and just 45 times book value, Citigroup also appears to be a bargain stock in addition to paying a significant dividend. Warren Buffett, a well-known investor and financial expert, started purchasing Citigroup stock in the first quarter of 2022. At the end of the third quarter, Berkshire Hathaway Incorporated owned a nearly $2.8 billion holding of the company. Through February 9, 2023, Citigroup stock had risen 11.6%. Number 2. Dutch Bros Incorporated. While large, well-known corporations like Apple might provide investors with some security, smaller businesses have more possibility for growth and can strengthen portfolios. Enter the quickly growing coffee business Dutch Bros, which is more than $6 billion in value despite being just about 1/4 the size of Apple. Sales increased 53% year over year in the most recent quarter, expanding like a plant. With its origins on the West Coast, Dutch Bros now has 671 sites in 14 states, almost all of them in the West and Southwest. Its drive-through locations are relatively inexpensive to open due to their tiny footprint, which enables quicker expansion. Numbers support this. Dutch Brothers added 133 new locations in 2022, representing a 25% location expansion. Beginning in 2023, investors have been pouring money into them. It's been the best performing stock of the 10 choices, with shares up 30% as of February 2023. And number 1, Apple Incorporated. The largest publicly traded corporation in the world, excluding government-backed behemoths like Saudi Aramco, is Apple. Apple shares, like other IT firms, struggled in 2022 as recession worries and skyrocketing interest rates alarmed investors in the industry. Apple currently prices at 25 times earnings, providing investors with a good entry opportunity into the $2.4 trillion iPhone manufacturer after a rare 26.4% decline in 2022. Although its most recent earnings report technically fell short of projections, supply chain bottlenecks rather than demand problems were the primary cause. In actuality, Apple claimed to have more than 2 billion active devices installed, and its high-margin services business generated more than $20 billion in revenue. Apple's stock is recovering from its 2022 problems. As of February 9, 2023, shares were up 16.1%. If you received value from this video, hit the like, subscribe, and click the notification bell. Please share this video with your like-minded friends. Till next time!